Good afternoon. It's Jim Turner, CPA, the BizValGuy. I'm excited to bring to you today some content that I think you're going to find very timely. Whether you're wanting to value a business or you're wanting to buy a business or sell a business, these 10 things that we're going to talk about today are things that you need to know. So without any further ado, let's jump right in. Zig Ziglar said, "You can have everything in life you want. You will just help enough other people get what they want." And I certainly have found that axiom to be true in my life. So the first thing that you need to know out of the top 10 is that the drivers of business value, the essentials. The first item that I'd like to mention is that cash flow is usually a bigger driver of value than revenue. And what do I mean by cash flow? I mean EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Now, seller's discretionary earning, which is used quite frequently among business brokers and some bankers, especially among Main Street businesses, is EBITDA plus one owner's remuneration. So again, it's EBITDA plus one owner's remuneration. The thought here is that the buyer could replace one owner with their labor. So again, if there are more than one owners, it's not two owners, salaries added to EBITDA, it is just one owners. The other cash flow metric that I would have you be aware of is the net after-tax cash flow. We use that a lot in professional business valuation with the income approach. The second element of business valuation that is a driver is the quality of earnings. A diverse customer base equates to less risk for a potential buyer. It means that you've got numerous amounts of customers, not just one or two or three or four, but you have a numerous amount of clients. Sometimes one or two clients can be okay if the customer is well established, like a publicly traded company, or there is something unique about that customer that makes them less risky to part ways in the event the business is sold, your business is sold, or a business is sold, the selling business. Recurring revenue bodes well for a higher quality of earnings than a business with a one-off sales model. So that is pretty intuitive. Supplier diversification can affect cash flow quality too. We saw this during the COVID era where we had shutdowns all over the world, and so folks who relied upon suppliers in certain parts of the world, especially China, were having a difficult time getting inventory or raw materials or finished goods, for that matter, to come in from China. It was locked down for a long time. So supplier diversification can affect the quality of earnings too. And the third thing I would have you note is that the organized labor force is critical. When you are selling a business or buying a business or valuing a business, the organized labor force is so critical. It is often thought of as the most important asset in a business is the people that work there. I think we've all heard that expression before, and it is certainly true with business valuation. The typical case is that the labor force is critical, and a solid labor force will bode well for a good valuation. So let's go to the second thing you need to know. Normalizing adjustments. Normalizing adjustments are what professional evaluators refer to them. These are referred to as add backs among business brokers and other folks who deal with Main Street businesses. Most Main Street and Mid Street valuations begin with unaudited tax or book basis financial statements. The cash flow must be adjusted to economic reality or as if publicly traded. Owner's compensation must be examined to determine if it is inadequate or super adequate. What I mean there is that as owners of a small business, the owner can pay themselves a very small salary or a super opulent salary or anything in between. What we're going to look at here is it a market wage? If it's not, we're going to adjust the cash flow stream, normalize it, if you will. We're going to look at rent expense paid to a related entity, such as if the owner of the business also owns a separate entity that owns the real estate that is in leased back to the business, we need to look at that rent to see if it is at market value. If it's not, then we'll make an normalizing entry there. Lavish lifestyle expenses need to be adjusted from the income stream. You could think of this as say a CPA firm whose partner drives a Lamborghini and puts that on the books of the business and writes it off as a business expense because they travel making site to site or customer to customer, meeting with clients and doing audit work or what have you. They don't need a Lamborghini to do that. And so that business is being hit with expenses that are coming from a lavish lifestyle. That would be one example. Another example would be maybe not in a lavish lifestyle, but just personal items that hit the income stream need to be normalized. Another point that needs to be looked at is salaries paid to inactive family members. They need to be adjusted. This would be, say, a spouse who doesn't work for the business. They're inactive, but they're getting a salary. Though that salary is unnecessary for the business to be operated, so it would be added back to the cash flow stream. These things, this next part, are often mistaken for an add back. Shareholder distributions, draws, and dividends. Those items are not add backs. They're not expenses. They actually are equity items. They affect the balance sheet, the equity section, and not the income statement. They do not affect the profit and loss or income statement. And, but oftentimes I will see folks when they're doing their normalizing or quote add backs, they will add back shareholder distributions, or if it's a Schedule C, they'll add back owner draws, or if it's a C Corp, they'll add back dividends. And this is all a mistake. These are not expenses. So just remember that. Cell phone is an example of an expense that I see added back. You'll see it added back. If you look at a deal or something where you're looking at buying a business, sometimes if you're a seller, you may think you add that back to expense because you're running your personal cell phone through the business. But I don't think that's an add back in our current economy, because most of us business owners need a cell phone to operate our businesses. A lot of our customers have our cell phone number, and we use our cell phone to call our customers and to conduct business. So that is not an add back. Number 3, rules of thumb. Are they reliable? There's an adage, I'll use the CPA firm rule of thumb, that CPA firms are worth 1 times annual revenue. That's an informal rule of thumb. Now, there is a more formal rule of thumb book called the Business Reference Guide, and it is published by the company called Business Brokerage Press. And so you can buy the Business Reference Guide from Business Brokerage Press. In there, I took a look at CPA firms to see what are CPA firms, what's the rule of thumb given to CPA firms. And sure enough, the Business Reference Guide uses the 1 times to 1.2 times annual revenue as a rule of thumb. They also use a better metric, which is the cash flow at 2.2 times EBITDA. I still wouldn't use a rule of thumb. And they also go on in the Business Reference Guide to mention some items that will affect the rule of thumb. Most valuable are CPA firms are ones with long-term clients, long-term employees, diverse client base, good systems, record keeping, etc. And accounting firms in major metro areas will, with solid fees, they sell for higher levels of revenue, is what this rule of thumb is saying. And it's also dependent on the type of clients. They're indicating down at the third bullet point here that 1040 clients result in lower pricing, monthly and retainer clients result in higher pricing. And then audits are preferred by a minority of firms. Again, that's just speaking to those firms that are in the market to buy another CPA firm that does audits, or it could be an individual who wants to buy a CPA firm that does audits. And not all CPA firms do audits. So that is something that this book has pointed out, that those firms could be worth more. Number 4, let's talk about cash flow versus revenue again. We're going to look at an example. I ran some comparable sales. I found 24 comparable sales in North Carolina, South Carolina, and Georgia, and revenues between 223K or 1,000 and a little less than 1.5 million. And what I found was exactly what I mentioned on the earlier slide, was that cash flow was the catalyst for sales price, not revenue. And we're going to see on the next slide, I've selected 3 of the 24 items on comparable sales on the next slide that we can look at and hone in on exactly how it's cash flow that is driving the sales price and not revenue. So let's go look at that. Here we are on the slide. We've got 3 firms here out of the 24 that sold. These 3 CPA firms sold, and they all had revenue between $395,000 and $433,000. So they were close to the $400,000 in revenue. But look at the sales prices. One sold for less than $300,000 or $400,000. Another one sold for right over $400,000 at $450,000. Another one sold for significantly more than $400,000 at $600,000. So what was the real driver? We know revenue is not a good predictor of the sales price, because we can see these all have similar revenues, as we mentioned earlier. What's really driving this is cash flow. So the cash flow is for the 3 comparable sales was 128 for the third one, 204 for the second one, and 269 for the first comparable sale. And we'll see that first comparable sale with the highest cash flow sold for the most money. And the one with the next highest cash flow sold for the second most money. And the one with the lowest cash flow, guess what? It sold for the least amount. And so we see that revenue is not a good predictor, but cash flow, the SDE, is what I focused on here, even though I do prefer EBITDA more over the SDE, because EBITDA does take into account the cost of the owner's work and labor, whereas SDE adds the one owner's compensation back to cash flow. What I'd have you look at here, and to really is the focal point, is that for the comp number 1 that sold for the highest multiple, it sold for the highest sales price, 62% of its revenue came back to the owner in the form of seller discretionary earnings. So if you took SDE here of number 1, 269,587, and divided it by the revenue, 433,319, you would get 62%. So for every dollar revenue, a lot of it ended up in the owner's discretionary category, seller discretionary earnings. Whereas the firm that sold for 450, or that sold for rather 365, which was the lowest selling price, only 32 cents of every dollar of revenue ended up in the seller's pocket. And you can see that that was the real driver of what the sales price was, the cash flow. and not the revenue. Now I'm going to take a look here. We're going to take a look here at those 24 comparable cells. Now I'm going to plot them on a scatter plot. And I want to show you how powerful cash flow is, how it predicts the sales price. So in this scatter plot, you may recall from statistics that the x-axis is where the independent variable goes. In this case, it's the seller discretionary earnings or cash flow. On the y-axis, we have the dependent variable. This is the variable that is being affected by the independent variable. And so for every movement of the x-axis, the y-axis goes, it moves as well. And in this case, for every dollar of seller discretionary earnings, the y-axis or the sales price goes up $2.56. So we would expect that a $300,000 SDE would sell for almost $800,000, or right at $800,000. We would expect that $100,000 business with $100,000 in SDE should be somewhere right in here between 0 and 150. It would sell for 256, so it would be somewhere up here. And that's what we see from the Y. That Y is the slope. So for every dollar of SDE, the sales price goes up by 256. And you might ask, well, what's the relationship? Like, how good is the cash flow at predicting the change in sales price? And that measure is called the R square, or coefficient of determination. And what this tells us is that the independent variable seller discretionary earnings is predicting the sales price with 98.4, can predict the change in sales price 98.8 or 98.34% of the change in sales price can be explained by the independent variable cash flow. So this cash flow is explaining a significant amount of the movement of the sales price. And that's what we see here with the scatter plot. Now, we know that it makes sense that cash flow would cause the sales price to increase. This is called causation. So there's correlation here. This is highly correlated, measured by the R square. We have a good correlation. But do we have causation? And the answer is yes, because it is intuitive that if I can get more cash flow out of a business, then I'm willing to pay more for that business. An example of something that would not be intuitive is that every day the rooster crows, and the sun comes up. And if we were to plot this on a scatter plot for 365 days, we would basically have a R square of 1, because it would be 100%. The independent variable could explain the sun coming up 100% of the time. Every morning the rooster crows, the sun comes up. But does that make sense? And the answer is no. We know that it's not the rooster making the sun come up. Even though there's correlation there, the rooster is not causing the sun to come up. What's causing the sun to come up is that the sun, or is that the earth is spinning on its axis, and every 24 hours it spins, and we have night and day. And so it is the earth's spinning on its axis as it orbits the sun that causes the rooster to crow, and not the rooster causing the sun to come up every morning. So again, that is an example. The rooster crowing and the sun coming up is correlation without causation. You want to use common sense with that. So the next item we're going to talk about is business valuation, calculation engagement versus evaluation engagement. The American Institute of Certified Public Accountants recognizes two report formats in its statement on standards for valuation services. Number one is a calculation engagement. In that engagement, the valuator and the client agree on the valuation approaches and methods the analyst will use. A calculation engagement does not include all the procedures required for a valuation engagement. The second type of engagement that the AICPA SSBS number one recognizes is a full scope, bulletproof, more rigorous report called the valuation engagement. Now, the calculation engagement, as long as the valuator and the client agree that the evaluator is going to use reasonable and applicable methods, is a cost-effective way, as we'll see in a minute, to get a valuation performed in a situation that doesn't really need the full scope valuation engagement. Calculation engagements can be done for buy-sell scenarios. It can be done for planning. It can be done for maybe even some small gift tax or estate type of scenarios where the gift is negligible or the estate is not going to hit the unified tax credit. Now, the valuation engagement, on the other hand, the more rigorous report, that report is recommended when you're going to go to court. Say two shareholders are fighting over the value of the business. One shareholder wants to buy the other one out, or perhaps you have a scenario where the estate is worth so much that it may wipe out the unified tax credit, which is basically a business worth more than $15 million. Then in that case, it would be prudent for the client to engage the evaluator for a valuation engagement. Also, a gifting of privately held shares, where you're going to get a tax write-off with the IRS for gifting of your shares to a charitable organization or other qualified gifts. Those should be done on a valuation engagement level, not a calculation. Our calculated values are rigorous, and we tend to utilize methods and approaches that we would use if we were doing a valuation engagement. So oftentimes we will advise a client, just engage us for a calculation. You don't really need a valuation. But it is case by case dependent and according to what the client and the valuation analyst agree to. Number 6 of the top 10 things you need to know about business valuation is that SBA business valuation for lenders is governed by SOP 5010, and right at this current time 8. So that's 5010-8. And there's a business valuation requirement for a change in ownership. There's the general rule is that if intangible value is greater than $250,000 in the deal, let's say a business is being sold and the buyer wants to buy it for $1 million and the seller wants to sell it for $1 million, and the lender has agreed to loan the money, but they're going to use a SBA loan product like the 7A government guaranteed loan product. Then if the goodwill is more than $250,000 in that deal, then an independent business valuation will be required. Now, another scenario occurs is if there's a close relationship between the buyer and seller, even if the intangible value is lower than $250,000, it may still require a business valuation based on the SOP rules. But if there's a close relationship between the buyer and seller, like family members or all already existing owners, maybe a 5% owner wants to buy out a 95% owner, that would trigger a valuation regardless of how much intangible value there is. Qualified sources, which is on page 410 of the current SOP, includes CBAs, ASAs, ABVs. I'm a CBA, I'm a certified valuation analyst. I'm also a certified public accountant. The CBA is one of the qualified sources. I would just say that if you are looking for a qualified source and you're a lender or you're a buyer, a good qualified source for valuations also should have experience with transaction business valuations and should have experience with the SBA formats for business valuation, because they do require some special reporting within the business valuation that a novice will likely not be aware of. And then finally, the minimum injection for an SBA deal, 7A, is 10%. So if a business is being sold for $1 million, 10% will be 100,000. That will be the minimum equity injection, down payment, if you will, that the lender has to require. There are a few exceptions. One of those is that a seller can make a seller note, and up to 5% of that seller note could be used toward the buyer's down payment if the seller note is put on standby. The next item we want to talk about is equitable distribution valuation. This is divorce court, and I'm going to be talking about North Carolina divorce court, but this could be applicable in South Carolina, Virginia, and many other states. Perhaps the rules vary slightly in some other states. Community property states, it can vary more, and certainly the valuation dates can be different. Active passive rules might be a little different, but in general, here's some of the key dogma of equitable distribution valuation. The judge, the trial judge, or the court must determine the value of, in this case, the business. They're going to want business valuations to help them do that, but ultimately it's up to the court to decide. Marital property is valued as of the date of separation. Again, this is for North Carolina. Passive appreciation and diminution in the business after the date of separation, but before the date of distribution, is divisible. Divisible unless it's caused by actions of one spouse. So this would be if a spouse intentionally, let's say, sabotages a business, that's actively disparages the name of the business or what having, causes a decrease in value, that would not be divisible. Decrease in value would be separate. On the other hand, if an owner spouse works extra hard and they go from working 40 hours to 80 hours a week, and the business does increase in value, a portion of that increase would likely be from active appreciation, will be separate. The passive appreciation would be from factors that cause the value of the business to increase that were external to the business, like inflation. Other key employees can be a passive, can cause passive appreciation or diminution. There's no single approach that's best for valuing a business. You could use an asset approach, a market approach, or an income approach, and no single approach is best. IRS Revenue Ruling 5960 identifies 8 factors that are really fundamental in valuing privately held businesses. And this treatise has been around since 1959, and it has stood the test of time. Modern business valuation methods and standards have, a lot of them have arisen from Revenue Ruling 5960. And then finally, I have you know that in North Carolina, a business doesn't have to be sellable. A lot of times I'll hear people say, well, more of attorneys or the owner of the business, well, I can't sell it because I'm the only person, or I can't sell it because I'm the only person or the only employee, and it's not sellable without me. That doesn't matter. Or if you had 50 employees and you could, some people would still say, well, it's still not sellable because the business relies on me. I know all the customers. Really doesn't matter to the court. The court in a case called Hamby versus Hamby ruled that a nationwide insurance agency, which could not be sold, absolutely could not be sold, because Nationwide owns the book of business with their agencies. Even though that book of business couldn't be sold, the court ruled that the value that that business had to that book of business had to the husband in this case, um, that was above the value of a reasonable salary, was divisible and part of the marital estate, even though it was not a sellable business. So just something to be aware of. Number 8, the approaches to value and when they're applicable. So the asset approach is a general way of determining value indication of a business using one or more methods based on the value of the assets less the liabilities. And so this is going to be one of my favorite methods for this is the adjusted net asset. And what we do with that method is we value the cash, the receivables, the real estate, the machinery and equipment, all at fair market value, and then we subtract all the liabilities. And the sum of that is the adjusted net asset value. The market approach, which we looked at earlier in my example with the CPA firm, if you saw that slide, that is where we take market comparable sales and we get a metric. We select a metric like EBITDA. We say, well, what did these, let's say in our example earlier, 24 comparable sales, what did they sell for as a multiple of EBITDA or as a multiple of seller discretionary earnings? And let's just say that we get a 4 times EBITDA for 24 CPA firms. Then we use that number, the 4 times EBITDA, to value the business. Let's say that the adjusted EBITDA was 500,000 and we're using our 4 times, let's say 4 times EBITDA was the median of the 24. Then we're going to value that business taking the adjusted normalized EBITDA, 500,000 times 4, and we're going to value that business at $2 million. Another approach is the income approach, which I think is, tends to be the most preferable approach. The market approach can be preferable if you find a lot of comps that are really similar to the subject. But like with a franchise, say Subway businesses that have sold, or some sports clips, or another one would be the fire, water, and restoration damage company known as ServPro. That's another one. And, you may get 20 comps for those types of businesses of franchises that have sold, and that might give you a really good indication value where you get that multiplier of EBITDA. And then again, going back to the income approach, it is my preferred method if I don't have really good comps. I use the income approach regardless of whether I weight the asset or market approach. I tend to use the income approach as a sanity check. If I don't weight it, I tend to weight it though. But if I don't weight it, I do use it as a sanity check. And what we do with the income approach is we take the benefit stream of the company, and usually for us, we take that net after-tax cash flow and we convert that into a single period, and we then divide by a risk rate or a capitalization rate. That's the capitalization of earnings. And that's the approach we use most often to value established businesses that don't have a lot of growth or a lot of decline. If they're having a lot of growth or decline, we'll use a discounted cash flow method, which looks at multiple periods, and we use discount rates to convert the value of those periods of income streams back to today's dollars. And then we'll use a terminal value for the value of the terminal cash flows after the projected cash flows have been valued. So we're going to move on now to number 9. Why is 51% 100% better than 49%. So if you're buying a business, a lot of times you may, you tend to buy, most people tend to buy 100%, but we value businesses that sometimes the deal is between shareholders, um, and or it may be a situation where we need to value a 25% interest in a business that is going through some kind of a legal issue, or 25% interest because it is being gifted. So we may have to value less than 100% interest, and sometimes less than a 51% interest. So when we get into this less than 51% interest, there's no more important element, characteristic of an equity interest than control. It can be argued that that's the most important, because with control, if I own 51% of a business, then I can acquire or dispose of assets. I can dictate dividend or distribution policy and payments. I have the power to hire and fire. I can revise company organizational documents. I can enter into legal agreements unilaterally, on and on and on, with 51%. With 49%, I can't typically do any of those things. And so when we see a value of an interest that's less than 51%, less than 50%, then we need to start to consider whether the interest being valued or bought or sold, is it worth a proportionate share of the overall business value? In other words, we've got a $10 million value. Is a 25% interest really worth 2.5 million, or is it worth less? And a lot of times it's worth less. And that's because of the control issue. Another issue is the marketability issue, is that if I own 25% in a business, it's going to be difficult for me to sell my interest. There's not a ready market for a 25% interest in a business. Now, there is a ready market for a 100% interest in a business, and probably for a 51% interest in a business, where the 51% is going to have control. There are websites like BizValGuy where you can definitely sell a 100% interest in a privately held business. But as far as I'm aware, there are no real markets available, readily available, discernible markets where you can sell a 25% interest in a small privately held business. There may be pockets of some markets that deal with certain types of assets. We're going to talk about one in a minute, that is a pocket for specific types of private equity. But in general, you will not find a market for a 25% or a 49% share of a business. So finally, number 10, one of the main reasons, one of the main impacts on the discount for control will be the dividends or distributions that are going to be paid. And this is why 51% is 100% better than 49%. So the distributions or dividends will have a significant impact on the discount for control. And this is intuitive if you think about it, because if I'm going to go back to that $2 million investment, and let's say the owner is asking $2.5 million for a 10% or 25% interest in $10 million business, then I'm going to make my determination on whether I would pay $2.5 million based upon several factors. And one of the most important is going to be, I'm going to ask them, or I'm going to look at their distribution policy. Number one, have they been paying distributions? And if they have, how much in distributions are paid out every year? And will that continue for my 25% if I buy the 20%? If the distributions are significant enough, I may not discount the 2.5 million. I may say, okay, yeah, I'll pay 2.5 million. For example, if the distributions are $1 million a year for the 25% interest, then I will probably buy that interest if I'm going to continue to get $1 million a year. And I'll pay 2.5 million. I may pay 3 million for that interest. And just according to the characteristics and the due diligence and the bond, the viability of that business. So, but if I ask that owner who's selling a minority interest and they're not paying any distribution, then I'm not going to pay a full price for the 25% interest. In my example, the $10 million business and somebody's wanting to sell 25%, there's no distribution being paid, then I am going to discount that. And I've got a study here from Partnership Profiles that shows if the equity business is not distributing, there tends to be a discount in privately held real estate partnerships businesses that where the study came from. They sell at a 36% discount from market value. Now, if they're distributing and they have low to no debt, they sell at a 19% value. And if they're distributing and moderate to high debt, 17% discount, their marketability. So, or discount for control. So in this case, I would pay basically 81% of market value. In this case, 83%. In this case, I would only pay 64% of market value for equity non-distributing. And the reason is because I'm going to have to hold that investment for a while before I get my return back. And I'm going to pay less now in order to increase my return later. So we're going to take a look at this in a sample we did years ago, Valuation. We valued the business at $1,770,000 for 100% interest. We were valued at 25% interest. So we first started with the discount for control, and we determined the discount for control was 15%. And then we looked at the discount for marketability or liquidity, because we knew that this business, that 25% interest in this business would be hard to sell. So we discounted the 25% interest even further by 24%. So we had a non-marketable, non-controlling interest, 100% valued at $1,143,000. And then we get a 25% equity interest in that discounted number. And so we came up with a value of $285,855 for the 25% interest. We rounded it up to $290. And then we had done the math behind of it. This is the math behind it. So for that interest, we knew they had been paying distributions. We knew we were going to get our 25%, or the buyer was going to get their 25%, or in this case, a hypothetical buyer, hypothetical seller. The value conclusion was $290. So in the hypothetical scenario, in year one, there would be a $290,000 investment. And then in year one, there would be distributions received, year two, year 3, 4, 5, and 6. We assumed that at the end of the 6-year holding period, that this investment would sell a pro rata share of the total investment for the 25% would be at $350,000. So we assumed the business would sell for $1.4 million in 6 years. It had been, we assumed that our interest, our 25% would sell for $350,000. And we, using the internal rate of return calculation in Excel, we got a 12.51% internal rate of return, which was acceptable for this particular investment. It was not too risky. It was it was a stable income stream for this investment, and the distributions certainly helped to give us a return that was adequate. If this were less than 12.51, like let's look at a scenario where there are no distributions. If there are no distributions for the same scenario, you go year one, you pay the 290, year two, year one, no distributions, and year 1 through 5, no distributions, and then you get 350, and year six, your return's only 3.18%. This would not be a good investment, because you wouldn't want to invest your money in a small business that would only return 3.18% when you could put it in a money market that would generate that much return, and there's no risk, very little risk. Or you could invest it in 10-year treasury bills with the U.S. government, which would have no risk, or very little risk. The least, we call that the risk-free rate, whatever actually the 20-year treasury is what we use as the risk-free rate. But you can see where I'm headed with that. You can tell that without the discounts, with no distributions, this particular deal would not be worth paying even 290 for. We would discount this even further. But because the distribution was being made here at 33, our discounts were reasonable. And then finally, any questions, you can respond at the bottom in the comments, or give us a thumbs up if you like this video. We would love to make more content. Your likes and your thumbs up and your comments help us to know that we need to continue to make content. And if you want to ask a question, I'd be glad to answer it. Just again, in the comments below, please answer there. And I'm Jim Turner, CPA, the BizValGuy. Until next time, saying good day. Thank you.